Welcome everybody. My name is Clay Malcolm here at Advanta IRA, and I'm delighted to be joined by Dave Steck today, and he's going to be our expert guest presenter and be talking about short-term vacation rentals. And Dave I got a chance to see Dave's presentation or a preview of it, and it's really going to be fun. So I'm going to try to make my part relatively short, so that we can get Dave on and get some information to you. So from a housekeeping standpoint, if you have questions about anything in the presentation, please do feel free to type those into the questions box on your console, and we'll answer them at the end of the presentation, generally time permitting, but usually we have time for a few questions, so please feel free to do that. I'm going to give you a little bit of information about self-directed IRAs, and in particular short-term rentals inside IRAs. And then, Dave's presentation is a little bit broader than just IRAs, but I think that everybody's going to get a sense of a strategy or two that they might want to use. So again, I'm really excited about getting this information to you today. So without further ado, that's questions, and yeah, okay. So without further ado, let's get going. All the information in the presentation today is for education purposes only. At Advanta IRA, we don't give tax, legal, or investment advice. We don't advocate any particular investment strategy, investment vendor, or even asset class. And we certainly encourage you to talk to your financial team anytime that you are vetting an investment. In a self-directed IRA world where the account holder is choosing the investment, the due diligence process does fall on the account holder. So it's your due diligence and up to the level that makes you satisfied that it's the investment that you want. Again, we are not vetting any of the investments. We're really here to document the activity of the account so that you get to keep the tax advantages that are associated with the account type. Our role is really pretty neutral. We're here to basically take your directions and make sure that it's documented properly so that you get to keep the tax advantages. And Advanta IRA, just a little bit about us, is we are built as a customer service organization in the way that our company is structured. We're very interested in employee education as well as keeping employees, so long tenures. We're a kind of a medium-sized company in the self-directed IRA space. So I think the nice thing about that is that we're big enough that we've seen pretty much everything, but we're not so big that you don't have your team's phone numbers and email addresses. So at Advanta, you get a two-person team, usually an education person like myself, that talks about onboarding and strategies and account types and things like that. And then you also get a dedicated account manager, who's more of the back office, nuts and bolts, paperwork person. So that two-man team is the team that you will have at Advanta throughout the life of your account, and you always know where to go for information. Now, a little bit more specifically about self-directed IRAs. For those of you who are new to this, and there may be some of you on here, understand that the account types themselves are the same. So a self-directed IRA is not an account type or a legal distinction. It's really just a marketing or a descriptive term, that self-directed part. The account types are the ones that you know, traditional Roth IRA. Some people are a little bit unfamiliar that HSAs or health savings accounts can also invest like this. So it is an individual custodial account. For businesses, there's a SEP IRA, simple IRA, and solo 401ks we handle as well, and education savings accounts. All of these account types can invest in alternative assets as long as you have your account with a provider like Advanta that handles alternative assets. And what I mean by alternatives essentially is everything other than publicly traded securities. So the IRS allows these assets in these account types, but you do have to have a provider that knows how to do the bookkeeping and the administration so that the account stays in good standing and you get to keep the tax advantages. So really what we are talking about with self-directed IRAs is combining the tax advantages of those account types that I just showed with alternative investments. And that can be, the most popular ones, obviously, from a categorical standpoint, are real estate. We're going to talk specifically about short-term vacation rentals today. Private lending, private equity replacements, precious metals, cryptocurrency has certainly seen a surge of interest recently, and things like that. So that account stays the same. The only thing that's different about it, and that you might recognizes a change from your bank or brokerage house IRA is that instead of that money that you contribute or roll over or have inside the account buying publicly traded securities, is that it's going to buy one of these assets, a piece of real estate, or maybe make a loan or a private placement, something like that. So that's the combination that we're talking about today. And specifically today, we're going to focus on real estate. So understand this, that an IRA can own real estate in a number of different ways. So it can be 100% owner if the IRA has the full amount of cash, can buy a property outright. It can use debt leverage, so an IRA can actually take out a loan in order to purchase a property. So the IRA does not have to have the full purchase price in that scenario. It also does not have to have the full purchase price if it has partners. So an IRA can be tenants in common with other owners, and the other owners could be other IRAs or people or companies. And there is especially when it comes to real estate, there is a technique or a strategy called checkbook control that may come into play. So your IRA could either be a participant in an LLC that has multiple investors, so you're just an equity participant in an LLC, or it could be more of a single member LLC type scenario, otherwise known as checkbook control. And if you want more information about any of these ownership strategies, please do feel free to reach out to me. I'm happy to explain them in detail. But understand that your IRA can purchase real estate in a number of different capacities or variations in terms of the ownership structure. And, I brought that up primarily because today we're talking about short-term vacation rentals, and there are some things that I want to point out specifically about that as an asset inside your IRA, whether it's traditional or Roth or solo 401k, any of those. So do understand that your IRA could buy a property anywhere in the world. The IRS doesn't care about that. The logistics in some countries are going to be more difficult than others. So there's definitely a predisposition to have the property be in the United States, but that's not necessary. But there are things that I want to point out that, sometimes short-term rentals do have local laws that apply, and they will apply even if your IRA is the owner and not you personally. So do understand that your IRA, it's a legal and financial entity, and it's separate from you personally, and it would be the owner, and it does need to follow any local laws that apply to short-term rentals. Also, in some cases, there are local or state taxes or other types of restrictions or just ways of doing business that you do need to pay attention to. So the place that you select is important because it will have an impact on the way that the property operates. Okay, next is property management. So one of the cool things about Dave's presentation today is it has some options in terms of property management. When it comes to IRAs owning a property, understand that there's a few things that you need to consider. You can hire a property manager, but you don't have to. You as the account holder are always going to be the decision maker, which means you can provide brain power, but not sweat equity or other physical work. Generally speaking, the IRS prohibits that. They see it as providing services or a contribution, a non-cash contribution to the account, so they prohibit that. And do understand that you cannot, as the account holder, and there are other disqualified persons as well that have this restriction, you can't get paid as the property manager. So you do want to, take time to craft how your property management is going to take place, especially if your IRA owns the property, because there are some restrictions there. It's not to say you can't kind of do it yourself. You can, but just understand that you want to take a moment at the beginning to make sure you set it up in a way that doesn't expose you to a risk of a prohibited transaction. And then I also just want to mention that one of the things that I think is really cool about your IRA owning a vacation rental property is it may very well be the property that you want to retire in. And so that scenario is alive and well. And it basically looks like this. Your IRA purchases the property. While the IRA owns it, you're not allowed to live in it or take use of it. So it's a rental property. And all of that income comes back into your IRA in its tax deferred state. So you get to keep the tax advantage as well. So your IRA is growing from the rental income. And then at such time, if you actually wanted to then move into that property as your retirement property, you distribute it in kind. So you never lose control of it. You basically just change the titling from your IRA's ownership to your personal ownership. And when you do that, all of the IRA or IRS rules prohibiting you from living there go away because it is now owned by you personally. So it is a way for your IRA to actually purchase the property that you're going to retire in later, and actually have it be making money for your IRA, and then you get the ability to just have that property as your retirement home. So it's a cool strategy, a long-term one, albeit, but a great strategy to think about and to be ahead of. So understand that that is a possibility. All right, I just have a couple more slides to just wrap up real quickly. And then I'm going to turn it over to Dave Steck, who's going to talk in much more detail about vacation rentals and give you some really cool ideas about investment strategies. So understand that I went through all the IRA part very, very quickly. We do have tons of other education, so please feel free to avail yourself of those things. We do events like this. We have a video library on YouTube. We have a blog on the website that's very informative, especially about current events. It's very easy to get started on a self-directed IRA and have it own real estate or any of the other alternatives we mentioned. It's really just a question of opening up the account, getting some money into that account, either via transfer from another IRA, rollover from an old 401k or other retirement plan, or even make contributions, or some combination of those things. And once your Advanta IRA has some money, then you're ready to start investing. And we're happy to help you with, again, the documentation to make sure that you get to keep the tax advantages. We do have an investment issuer forum, so you can network with investment issuers as well as other investors. We do it every other Friday. It's called Pitch, Promote, and Prosper. If you haven't visited that, been to that meeting, you should. It's really fun and very informative. So that's always there for you as well. It's free. There's no obligation. And this is my contact information. So if you do have further questions or you want to delve into some of these things in more detail, please do feel free to reach out. I'm happy to talk to you on the phone or via email, whatever's best for you. And talk about how this idea of vacation rentals and short-term rentals can be a part of your IRA investing strategy. And now I'm going to switch the screen over to Dave Steck, experienced real estate investor, private money lender. The list of things that you have going on, Dave, is so long. I think that I better truncate it a little bit, but I really appreciate you spending some time today and sharing your expertise and some of the investment strategies that you've used. I know that you like me are a self-directed IRA investor, and so we're all kind of part of the same process.
Yeah, we are, and I think I'm probably not only the poster person, but the poster family for self-directed IRAs. Not only, Clay, do you know that I have a pretty significant Roth and a SEP and a solo K, but my sons do, both my grandsons do. At the end of the day, you can't start too early with what I think is sort of the last best kept secret when it comes to accumulating wealth, and that's self-directed IRAs. So I hope you guys are as passionate about it as I am. Now, as I go through this, Clay's already set it up. So if you have any questions, feel free to give him a call specifically about self-directed IRAs and how they relate to short-term vacation rentals or vice versa. So you're welcome to do that, but I'm going to jump in right now. And let me take a quick sip of water first. All right, I think I'm ready to go. So I am Dave Steck. We're going to be talking today about investing in short-term vacation rentals and basically about creating your retirement vision or even your non-retirement vision. In other words, you can do short-term vacation rentals, as Clay said, in or out of your self-directed IRA. I always have to start with a disclaimer. Certainly makes the attorneys happy. And the point on here that I really want to underscore is that my goal is simply to help you educate yourself and through me on various strategies that we've used in the spirit of helping you become a better informed investor. That's it. I don't have a book or a course on short-term vacation rentals, and it may or may not be right for you. It's really up to you to decide. This short-term vacation rental space has certainly changed a lot since we first ventured into the space, and it's literally changing daily. And I think the thing that I would want to know if I were you is how would you contact us moving forward? And the answer is just make sure to write this down. Accessinsiders.com/Advanta. Clay mentioned to me before we got on here that there's a couple hundred of you who are listening in. So you can imagine if I got a couple hundred emails, so that I won't be providing, but it is the portal for us to be able to communicate with you. So if you write that down, we're going to offer some things here at the end, and it may be something that you want to take advantage of. I want to welcome you from stay-at-home paradise. You see, I don't know where you are, and I don't know where you're sitting now, but this is literally where I am right now. That's the view off my balcony in the middle of winter. And I haven't left this view for over 12 months. And I argue, I laugh that I've actually got cabin fever. So just imagine making double-digit interest income every minute of every day, paying a flat 4% tax from a corporate standpoint, and investing from your self-directed IRA. That's basically the situation I have. Of course, the bad news is I have to look at that every day for over 6 years now. So I want to thank Clay, because without Clay, we wouldn't be here today. And so Clay, kudos to you and for everyone, honestly, for being here sort of in the middle of the day when you could be doing something else or at the beginning of your day. So without Clay, this webinar wouldn't have happened. And my desired outcome is to add value to Clay and to Advanta, and by extension, you. Now, just in case you're wondering, Clay and I connected through a mutual colleague who asked me to share my experience in short-term vacation rentals with you, that being Clay, and I hope it really helps you start thinking. And more importantly, I really want you to start doing. I'm not saying you haven't done anything to this point, but in 2021, I view it as the year of doing. Why? Because last year was the time to survive for a lot of us, and this year, it's the time to thrive. So thank Clay. Literally, if you loved what you hear today, I want you to email Clay and let him know, because I believe that recognition feeds the soul. Now, all of my investments start with research. My State of the Union for real estate investors, I've been doing this for 15 years. In Harvard in 2005, I said, get out of the market and get out quick, because I felt as though, based on 700 slides worth of research, it was about to implode. And sure enough, it did. But of course, no one bought that at the time because the market was on fire. Sound familiar? Think of what it's looking like today. And I didn't get invited back until, of course, 2008, when at that time I was asked what I was doing. And I said, I'm going all in Las Vegas. And of course, we all know that that was the foreclosure capital of the world. And so I didn't get invited back again until, of course, 2011, when 2005's and 2008's predictions turned out to be right. And I said, we're going to bottom out in the next 12 months. I need you to go in, all in, everywhere. And literally was on the basis of my training in economics and business that have allowed me to create a research arm of our company and our SEC family office that allows us to know what's coming next, and to really figure out how to leverage different strategies at different points in the market cycle, because it's always important to do what the market gives you. Don't try to do what you've always done, because it doesn't always work. So what are we going to talk about today? Well, number one, we're going to talk about buy and hold real estate. And you might ask, well, why discuss it now? Hasn't the market been on a tear for the last 9 years? Hasn't the bloom pretty much been off the appreciation rose? Good question. We'll get to that. How about short-term vacation rentals? I'll share our story, and I'll also open your mind to the possibilities. And then lastly, we'll talk about 2021 and whether there are opportunities today or not. So let's talk about buy and hold real estate. And why discuss it now? Why specifically today? Well, real estate investing and mastery in real estate is paramount to your self-directed IRA success. This is literally a triangle that I drew for my sons over 30 years ago when they were very young, and I was trying to explain the money game to them. So play along with me. What I said was, look, sons, if you want to win the money game, you've got to do three things. First, you've got to generate cash, otherwise known as income. Second, you've got to accumulate wealth, otherwise known as assets that both throw off income and go up in value. And third, you've got to keep it. Somehow you have to preserve it. Well, real estate from an income and cash flow standpoint can be gotten through either short-term or long-term rentals. Now, most of us tend to pivot to long-term rentals, but short-term rentals in terms of cash on cash return require a little more work, but generate a lot more benefit. Real estate can allow you to accumulate wealth. We all know that. Appreciation comes in three forms: instant, where you buy right; forced, where you improve the value by doing something to it, like a rehab; and market appreciation, where you're in the right place at the right time; and leverage. If you can get leveraged appreciation, you can accumulate wealth in real estate, and you can also generate cash flow. But what good is either unless you keep it? Well, that's what preservation is about. Not only not losing it, but also not giving it away to, let's say, the government. So you can take tax deductions. You can do 1031 exchanges. You can invest through your Roth or other self-directed IRAs, either tax-free or tax-deferred. You've got to master this game. It's not if, it is when, and when is now. At the end of the day, we're talking about buy and hold now because there are a number of ways to win the money game. And we all know what they are. You could be a private lender, which is how my family has made a fortune. And my son went on to build $1 billion company, the largest private lending company in America. You can leverage technology. You can leverage real estate. And all of these things we're going to be talking about. The real estate market is shifting. Just think of shopping malls or retail or hotel or office. Our family personally likes real estate more during some stages of the market cycle than others, because the market cycle is a wavelength, and there are certain things you do at certain points in every market cycle, and there are certain things you definitely don't do. Now, we can't always be at the bottom of a market like we were in January 2012 when the market turned and took its run. So the next best thing is shifts or corrections in the market. So the greater the shift, the greater the opportunity. So for the next 12 to 24 months, we as a family and our research, and we spend a fortune on it, and it's why I'm invited to Harvard to present it. We expect some shift. The real question is not if, it's when and how much. With COVID as the primary driver, it's not as easy as it was in 2005 to predict the future, because we now, courtesy of our federal government, have what's called artificial stimulus. So it's not a free market like it normally would be. And we need the best strategy for optimizing both reward and risk, especially during uncertain times like now. So we believe the real estate sector is really robust right now, but the best real estate sector or subsector is residential. And the best subsector is single family homes as opposed to, say, multifamily. Why? Both homeowners and investors want them. See, when you're buying or selling a 2 to 4 unit property or a multifamily, the only people that want it are investors. Single family homes, 90% of the buyers are homeowners, so it's easier to get out of them. We don't see a major shift in residential like in other sectors, like shopping and office and hotels and retail. The bottom line, we believe single family homes have the best risk-adjusted return in the next 18 months. And what risk there is, we can easily mitigate because we just lend or invest short-term. We flip, we wholesale, we lend, we do it out of an investment fund with our investors. But if the shift is enough, it opens an opportunity for medium to long-term investing because there's now an opportunity gap. So we need to start planning for a shift now. All of us on this call. Forbearance will create some foreclosures, and we'll see how many. But if the shift doesn't hit the fan, or as it were, or it's a minor shift, we simply won't execute on the plan. But having the plan, having the playbook, knowing that a shift could come, and knowing that it always does, is how you get filthy, stinking rich in real estate. And your playbook should have numerous strategies. Inexperienced investors do inexperienced things, so become more experienced or partner with people who are more experienced. You see, experienced operators know how to make money, otherwise known as income, or even accumulate wealth in real estate. Really experienced operator investors know, and we've done 7 or 8,000 deals now. We know how to generate income, accumulate wealth, and keep it. We know how to both own real estate and control it. And we know, guess what? That controlling is the faster way to wealth. We're going to talk about it on this webinar. It's a lot less risky. And of course, we could talk about owning it at another time. And here's the thing. You know you can own and control it if you're experienced, and you know you can rent it short-term or long-term. So the best thing for inexperienced investors to do is to partner with really experienced operators and investors. That's why we created a little over a year ago Access Insiders, who's actually hosting this. This is the research that our Access Insiders have in their modules, and this is literally a module from those. So let's start with how we got into short-term vacation rentals and how we did it a decade ago. Let's think back just 12 years ago to 2009. Seems like almost yesterday. What was the least desirable thing to own in real estate? Anybody have an idea? If you do, put it in the chat box. What was the least desirable thing to own in real estate? Well, I'll tell you what it was: luxury homes. You see, demand and sales, if we look at California in particular, for $1 million homes were dropping like a rock. If you look in 2005, there were 55,000 sales. It dropped to 50,000 and then 42,000 and then 24,000. And literally within a 4-year period, it dropped 65% in terms of volume. Well, other high price states and markets had the same impact. And here's where we were when I was doing this research. We were in 2009 trying to anticipate a bottom of the market, which we forecasted in the luxury space in 2009 for 2010, and you can see it happened. So we use research as our unfair competitive advantage to know where we are and to be able to forecast what's coming next, because we want to take what the market gives us. And what was the market thinking at the time? Well, on December 15th of 2009, I got a phone call from my bidder at the auction. And he said, I just heard about a sweet deal. And I said, well, buy it. That's your job. You're my bidder at the auction. So why are you calling me? And he said, well, it's not through the auction. It's actually an inside deal. And we've got 10 minutes to say yes or no, and I need 5 minutes to explain. And I said, well, you better talk fast then. And it turned out to be a luxury home. And from the research we did, I knew demand was low and dropping, and I knew inventory was sky high, just like I showed you. Well, unsold inventory by price range broke down like this. $1 million homes in California or above had 14.2 months supply in December 2009 when I was approached with this opportunity. And I knew it because we did this research. So I was able to pull up my research in 10 minutes and say, wow, I'm not sure I want to be there. 14.2 months supply. So as I said, it was a luxury home. And from the research we did, I knew that demand was low and inventory was high. And I also knew that a luxury home was not what we wanted, but I listened anyway. And here was the deal. This was it, an ultra modern loft style custom built home. It was built by a custom home builder as their private residence. It was 4 stories, 5,500 square feet on almost 2/3 of an acre lot. Now, these are pictures from 12 years ago. So if you wonder why they're not so good, it's because iPhones weren't what they are today 12 years ago when someone was taking photos of this, my bidder, and sending them to me. But it had a grand living room with a 30-foot cathedral ceiling, remote control curtains, high-def TVs all throughout the house, custom dining room furniture in every area. It had a custom kitchen with top-of-the-line appliances, had beautiful cabinets and granite countertops. The square foot master bedroom suite of 1,500 square feet was about 4 times larger than the trailer park I spent the first 20% of my life in, or at least the trailer. It had this amazing jacuzzi spa bathtub, double-sided showers, over-the-top shower with 8 massaging heads, had this beautiful walk-in closet, at a private theater, a custom-built pool table, a wet bar, you name it, it had it. Outside, it was even just as beautiful. And it even had a children's park for families. So you can imagine what that might be good for, right? Well, what would you pay for this dream home? Imagine 4 stories, 5,500 square feet, and a 25,000 square foot lot. Well, type it in the chat box. What would you pay for something like this? Well, let me give you a little bit more history. Turns out that it was built for 2.8 million in 2007 by a custom home builder. It appraised, because the market was dropping by 2009, for 2.125. The bank note was an 80% jumbo at 1.7. The owners were foreclosed upon. We bought it from the bank, and we learned literally 10 minutes before that there was going to be a vacation renter that was coming to go into the property. And then there were other surprises like all this furniture in there. So how much do you think we paid for it? $2.8 million home. What would be a great deal today on a $2.8 million home? And I'd be honest, I mean, yeah, a dollar would be a good answer, but that's not the right answer. So 2.8 million, what do you think? Well, we paid a whopping $618,600 for that property in December of 2009, and I had to scramble to close on it the day before Christmas, or I would have lost the deal. There was only one problem. What do you think it was? Any ideas? Well, I was 618,600 short. All of our money was literally deployed in flips, and we were broke. And we had to put together our first investment fund. Now we were on our 10th investment fund, and we literally put our first one together back in 2009, just over a decade ago, in order to raise money for just this project because we'd run out. By the way, I almost forgot about the view. You might have thought that it was in California. Well, it turns out that it had the only 180-degree view of the entire Las Vegas Strip. How cool is that? And so we rebranded it. It was a single family home, and we rebranded it a vacation rental called the Vegas Skybox. And that's what it looked like. So there was one other problem. What do you think it was? Well, think back to 2009. Think back 12 years ago. I couldn't spell vacation rental. I had no idea what to do with this property other than it was such a screaming deal, I couldn't say no. So we called 2 short-term vacation rental property managers and asked for their help. Now, I'm not going to go through this in the interest of time, but we had a list of about 10 or 15 questions. And we asked the first guy and then the next girl, tell us a little bit about vacation rentals. And we learned as much as we could in order to get into this business. We also started doing marketing. I don't even know if Flickr Photo Stream still exists. I also don't know if Google Knoll still exists, but those were the kinds of marketing that we were doing at the time. We did exclusively online advertising in 2010. Remember, this is over a decade ago on all these sites that you see here. And we had all these linking campaigns that allowed us to be able to ping and to bookmark and aggregate, basically to formulate a network of links to rank the domain, the Vegas Skybox, for targeted keywords. Well, we did a lot of other marketing. What else? Well, you name it, we did it. Things like websites. We had multiple websites. We had a website for poker players. We had a website for weddings. We had e-brochures for each one of those different applications. We were doing mastermind events where people would come and have what we called ideation sessions. I spent a lot of years with Disney, and we used to have Walt Disney Imagineers back in the Kodak days and the Disney days and when I was in corporate America. And we did a lot of PR. We were trying to get the word out about vacation rentals, and ours in particular, and doing video tours, and creating them out of nowhere, doing strategic hosting for people who we thought were influencers, doing trade outs. Our first websites were built by somebody who wanted to stay at the Vegas Skybox. We had investor gatherings there. The bottom line is this was all cutting edge marketing 12 years ago. And you might want to ask yourself, well, how did we do when we didn't know what we were doing? Well, in our first full year, we did $157,000. That's somewhere between $13,000 and $14,000 a month in rent off a single family home. Well, how would you like to do that? I mean, that's crazy. Think about a normal rent, 1,000 a month or 2,000 a month. No, 13 or $14,000 a month. Well, that went pretty well. So we said, let's do it again. So we raised another fund and we bought this one at the auction 2 months later. Now, what do you think we paid for that? Now your mind's really spinning because you saw the previous example, right? Well, guess what? We paid $247,000 for that property. How cool is that? And there is proof through all of the cashier's checks at the auction. But I forgot to show you the before picture. It didn't look like that when we first got it. It looked like this. It was literally a property that had been in foreclosure for like 3 years. So there's the before and after. And I don't have a lot of time to get into all the photos inside, but we built a new vacation rental basically from the ground up, except that we didn't build it new. We were using send out cards. So if someone stayed, we would literally send them a send out card thanking them, offering them $100 off of the next stay, offering them $100 for a referral, and I'll be darned if it didn't start working. We're also back then using Craigslist. And we were doing, get this, between our two properties, 900 postings a month because we'd sometimes get shut down and all of the things that for those of you who understand what I'm talking about, it was crazy. It was the Wild West in terms of advertising online. So we'd have all these Craigslist ads. And then we started advertising on HomeAway.com, which owns vacationrentals.com, HomeAway.com, VRBO.com, and a lot of other syndicated sites when I got to meet the CEO of HomeAway. Well, VRBO, we were doing ads, and then we started putting together those 5-page brochures to be able to have people click through to them. We were doing SEO. Won't get into all of this because it really isn't important, because what I want to show you is that we didn't know what we were doing, and we still made $157,000 in our first year. Now, to be fair, I'm not saying that that's what you should expect. And to be fair, I guess we knew something, but literally this was like the Wild West in vacation rentals. So how did we do on the vacation or on the Vegas Sandcastle? Well, $96,000 on an annualized basis in our first few months. So now we're realizing, my God, between the two of these, we've literally created a model that may be our next model. And now we had a downsell property. For those that couldn't afford the Vegas Skybox, we would downsell them into our Vegas Sandcastle. Now, keep in mind that that combined rent of $250,000 for only 2 properties was rent 12 years ago. So imagine what it is today. And short-term luxury vacation rentals weren't even close to being mainstream yet. You see, that all happened, that is, in 2009. What also happened that year, 2009? Anybody have any idea? Well, it was Airbnb's first full year of business. How crazy is it? And they're worth over $100 billion, and I'm not. But it's why you didn't see any ads on Airbnb in those previous slides, because they didn't really exist. HomeAway was the closest thing to it, or VRBO and vacationrentals.com. Our investors in both of these properties loved it. So what were we going to do next? Well, we thought, what if we bought 2 for $1 million, those 2 I just showed you, and that worked. Well, what if we bought 10? I mean, literally, what if we had 8 more purchases and we had 10 in total, and they performed like the first 2? We'd have $5 million in revenue and $1.5 million annuity stream. That's a 30% annuity stream. And what if we finance them? You get in the picture here? That kind of income, potential appreciation, and leverage is how we could have gotten filthy stinking rich. Make sense? Now, I said how we could have. What did I mean? Well, then we got a letter. Anybody know what's coming next? Well, you may or may not remember, but over 10 years ago, when Airbnb and VRBO and HomeAway came on the scenes, all of a sudden, vacation rentals started propping up. and the hotels didn't like it. So the hotels, who had significantly deeper pockets than they now do because Airbnb has really impacted them, hired lobbyists. And those lobbyists went out to the markets that were the most popular, go figure, Las Vegas, and started targeting those people and then working with politicians to pass prohibitions against them. Almost sounds unconstitutional, but it's true. And it still happens in some markets, I'm guessing. But at the end of the day, we get a letter on September 9th of 2010 that said, starting in roughly 30 days, there will be a lien, a civil penalty that'll be assessed on your property until you, quote, rehabilitate it. What does that mean? Our property's great. It's not even in an HOA. We had enough sense not to, put a vacation rental in an HOA where the homeowners association couldn't have given us free. But if you zoom in and you look at the conditions and the point, we had to cease daily and weekly rental of the property. We couldn't rent it for less than 30 days at the time. We had to discontinue all advertising. And if we didn't do those things, we'd have to pay a penalty of $1,000 a day. And by the way, this goes on to say in perpetuity. Can you imagine getting a letter like this when you didn't do anything wrong? All you did is put a vacation rental up that people loved it and spent a bunch of money to stay there. In fact, a lot of people stayed there and told us they didn't stay on the strip because they didn't want their kids to be handed, those cards. So we had a decision to make, and we had to make it fast. So we sold the skybox at a really nice profit to our investors, who not only got cash flow, but significant appreciation, and of course, paid a $29,000 fine 29 days into this whole mess at closing. So we had to scramble to sell that property. And then on the Vegas Sandcastle, we hired the best attorney that we could find and literally found out and had him convert it to a fractional ownership model. Now, I know it works in Vegas because we did it and we tested it, and it worked. So we literally put together, with his help, a 59-page business plan that includes all the things you'd expect in a business plan and an operating agreement, and it worked. We literally sold the 10 units that we had created. We sold 5 of them to one strategic investor at a 2x premium. In other words, we bought the home by the pie and we sold half of it by the slice, 5 slices out of 10 slices. And what did we do with the other part? We now owned half of a beautiful rent-producing home for free. The big message here that I want you to take away is that there are a lot of ways to monetize short-term vacation rentals, especially luxury homes, but you got to start with one home and start with one way. People ask all the time, where do I start? One home and one way. That's how you do it. And keep your mind open to the possibilities like we had to. Sometimes people force your hands. Maybe it's the market, maybe it's bureaucrats like happened to us, but at the end of the day, there's another massive lesson. And it's especially great when you do it with your family like I do. In other words, I have a family office that we've created to manage our wealth. And we're trying to do big things like helping you get to where you're trying to go quicker. There's no book or tape or boot camp that you have to go to on vacation rentals. We don't even have one. Our desired outcome is to give back. And how did we get here? Because we realized that you can be the victor or you can be the victim, and you choose. Think about that for a minute. What's the message that you want your kids to hear from you? It's not about woe is me. It's about let's capitalize on every pivot we ever have to make. And I can tell you, honest to God's truth, we have always been in a position that every time we pivoted, we came out somewhere better. And by the way, we're not out of this business by a long shot. Fast forward to today. How would you like to rewire, not retire, on $100,000 a year and live where you want for free? Now, maybe that's the first time you've ever heard rewire, unless you've been a follower of ours. But my sons, 3 or 4 years ago, when I planned on early retiring for my fourth time, said, Pops, get over it. You're never going to retire. The best you can hope for is to rewire. And I realized that you and I on this call are on this call because we're always looking for more. We're always on a quest for more. And in order to do that, we're always going to be active. The only question is, what's our activities? Do we watch a movie? Do we go on a date? Do we play with our grandkids? Do we make money? Do we find the next best thing? Do we find something that's been around that we just didn't discover because somebody else figured it out before us? And can't we cheat off them? Well, that's your opportunity here. Call me crazy, but here's what I believe. I believe that there are three types of places that all of us dream about living near or next to. What are they? How about the ocean? That's what I'm sitting next to now. The nicest 1 mile stretch of beach and probably 7 layers of aquamarine that I'm literally looking at now in Puerto Rico. Who'd like to live here? Next to the ocean with the sun shining and the waves crashing every day 24/7. Well, some of you may be mountain people. Who'd like to live in the mountains, enjoy nature in all its glory for 4 different seasons? Or on a lake? Who'd like to live on a peaceful lake, fish or jet ski, take a boat across the lake to a restaurant just for dinner because you can? Well, me, look, I live on the ocean, but I'm a lake guy. So last year, just for giggles, I challenged my team to find me a free lake home to live on, plus make $100,000 a year. And they looked at me like I had 2 heads until we started talking about the possibilities. What do you do first? We do research. We are looking for clues. And our big clue was Airbnb's single largest investment to date, a $300 million purchase of luxury retreats. What's the key word there? Luxury. So imagine, just for a minute, living your ideal lifestyle and getting paid to do it by living in that place, if you're a lake person. Imagine a 5-bed, 5-bath, 3,500 square foot lake home that sleeps 14. Following me here? Imagine sitting on the porch in the morning having your Java or your tea. Imagine lake views from every room. Imagine finding a room that doesn't have a lake view, which you can't. Imagine that this is now getting ridiculous because even the bedroom has a lake view. Imagine packing guests in like cordwood. Someone had a vision here. How about spa-like baths and showers in this beautiful home that you have? Seriously, I just want you to stop and imagine for a minute, living here for free, getting paid 100 grand a year, and never having to leave the lake, or making even more than 100. What if you could add a 0 to that? You know, if I could help you add a 0, how many of you would put me on your Christmas card list forever? Well, you don't have to do anything other than what we've done. And you don't have to do it with us, and we're not asking you to do it. I'm giving you an opportunity to imagine. Think about this for a minute. Who's in? So put in the chat box, if I could help you live somewhere for free, where you want, not where you have to, get paid over $100,000 a year and never have to leave the place, who's in? I'd like to think all of you are. And for those that aren't, you may have fallen asleep, and I regret that, but let's move on. Now, I know you got 3 questions, and I'll tell you what they are because they're the same 3 I had. Where is it? What about the 100,000 a year? And how do I get to live there for free? Make sense? First, where is it? Lake Norman, North Carolina. Easy answer. What a beautiful lake. How about getting paid over $100,000 a year? That takes a little explanation. Starting with research and analysis by my team, leveraging technology. Do you realize that there are sites like AirDNA and others that actually provide you this kind of information, where you can select a city, select a zip code, review property performance, review the active listings and what's called RevPAR, which is revenue per available room. And it literally gives you the way to cheat off data. You can also pull comps and look at a home and see where it is relative to other properties. How cool is this? Let's now look at the numbers. Now, this is an estimate, but I'm telling you, it's an accurate estimate. Imagine $136,000 off of one property that you don't buy, you only control, where you lease and then you sublet it to somebody else. Well, if this were to rent based on all the research that we did for $975 a night, if it were to be occupied 65% of the time based on the research we did, those 237 nights would generate $231,000 a year in gross rent. Of course, you've got expenses. First, you've got to rent it because you're renting it for $5,400 a month, and you're looking to lease it for considerably more on a sublet basis over a 12-month period by the slice. So you're ultimately renting it for the weekend or for the week or for the month, but it's not a one-year lease. Now, the cleaning you don't have to worry about because the tenant pays for it, but you've got a number of other expenses in order to maintain your property. And at the end of the day, it's $136,000 gross profit. By the way, you might ask yourself, well, could I lose money? Yeah, the break even would be 27%. If it's not rented 73% of the time, you'd start losing money. That's a great deal. The setup costs, what might cost you something out of pocket, and what we have done as investors in terms of lending money to others is we would loan as a private lender the $34,500 so that our partners, the vacation rental leasers who are subletting it, would be able to upgrade the furniture to whatever it needed, to put towels and soap, to get first and last months or first months and security deposit, and to be able to pay for ongoing maintenance. Because even though the housekeeping is reimbursed by the tenants, it allows you you're going to need to maintain the property. So now let's combine two concepts, which are massive: leverage and cash on cash return. So let's start with, let's just say you're buying a $100,000 home. Let's say you put 10% down on that home and you finance 90%. How much is 10% out of $100,000? In other words, how much skin do you have in the game? $10,000, right? Okay. Now let's say the market appreciates 10% and the $100,000 home goes up 10%. How much was that? 10,000, right again. So you literally got 100% cash on cash return when the market went up 10% and you didn't do anything. You didn't get forced appreciation. You didn't have to get instant appreciation. You literally allowed the market to do all the heavy lifting. So what's your gross cash on cash return in year one when you basically ignore what I just talked about in terms of appreciation and only look at cash? In other words, what you rented it for and what you netted. Well, in this case, it would be 100%. In other words, in this case, appreciation would yield you 100% cash on cash return. How many times would you like to do that? Let me give you the answer in case you don't have it. It's as many times as you can. So just consider this. Without that appreciation, $136,000 on a $34,000 investment that I made, the borrower didn't even make it, is a 400% cash on cash return. How crazy is that? How could you ever do that on a long-term rental? You couldn't. So that's why short-term vacation rentals are so powerful. Because if you rent them and then re-rent or sublet them, you don't have a massive expense in terms of having to put a lot of cash down and having a big mortgage payment. You do have a lease, which of course mitigates your risk because you rent it, you don't own it. So you control the asset and now you're able to get a 400% return. All right, the third question. Okay, you've got me at hello, but what about that living for free part? This is the part that's even more fun than the last one, and the last one's really fun. There's a catch. I'm the first guy to admit it, there's a catch. What's the catch? Well, you got to live in the 625 square foot guest house, right? You see that guest house? You didn't see that in those other pictures intentionally. Well, here's what you've got to do. You live in the guest house, you rent the main home, it's a vacation rental, it makes you $136,000, and what happens? You live free. Well, you're saying now, wait just a minute. I'm not going to live in that home. I've never lived in a 625 square foot home unless it were an apartment or a condo. Well, hold on, let's just take a quicker look at it. If you really kind of zoom in on this place, that's what 625 square foot looks like, including a bathroom. It has a full kitchen, and look at that view. Right next to that full kitchen is sort of a living area. So it's got a great / living room, including the kitchen. And on the other side, by the way, you can't see it, but on the left here, imagine that there is a little wall with a fireplace. That's the wall. And on the other side is a master bedroom, a king size bed with a fireplace. And best of all, it's got the same lake view as the main home. In fact, it's actually better because it's right on the lake. So you get that view, you jump in your kayaks, you head on down that river, you sit there at night. I don't know, is anybody with me on this? That is where I'd want to be. I don't know about you, but if you're a lake person, you're all in right now. Imagine doing the same thing on an ocean or in the mountains. I just want you to imagine for a minute, living here for free, getting paid over $100,000 a year, and never having to leave. Unless, of course, you got 9 more of them around there. Now you've got 10. They're all in the same area. And now you're admitting to yourself, it's a pretty interesting model. You see, if you're like me, you're realizing the benefits of minimalism. I moved to Puerto Rico. I'm now into my 7th year and sold 2 homes in San Diego and Las Vegas and a combined, 10,000 square feet. You now realize, or at least I do, having moved to Puerto Rico, after throwing away most of my stuff, giving away the majority of that which was left, and having a small storage locker in Las Vegas for the rest, that I could move to Puerto Rico with 2 suitcases and a backpack and have the benefit of recurring income up front in a vacation rental. 10 of these, take 10 times $138,000, is a $1.38 million profit business. And now your mind starts racing. It starts ideating. If the main home's rented 65% of the time, the other 35% is yours to do parties, to rent for strategic reasons, to invite Clay to come there, maybe do a trade out with somebody like we did on our website. You could donate unused nights to charities and get a tax deduction, have a second property with a guest home. In other words, imagine this. Now you've got 10 of them. Remember that guest home? You now move out of the guest home into something you really love, and you have a maid and a handyman in that guest home who takes care of all 10 of your properties. You could host a power of 6. You'll hear about that in a second. I'm going to give you a free report, no book or tape or anything, just a free report, but you're going to understand why you'd want to get fewer better people together to do fewer bigger things and have fewer deeper relationships. That's the power of 6. And imagine inviting them to something like your lake home. You live free on a lake, make 6 figures while controlling real estate, not even owning it. Now you could own it. And as Clay quite rightly pointed out, you could then hold it in your IRA, do all of this that I'm describing, and be able to take it at a point in your life where you're at least 59 and a half as a distribution. And again, Clay's the guy who's forgotten more than I'll ever know about that. But isn't it great to open your mind to the possibilities? But of course, many of you on this call are so full of yourself, ha ha ha. So you're saying that other lake house and that guest house is not big enough. Well, how about that one? You think you could make do with that place on the left there? And how about a mountain home? Do you think you could make do with that place on the left there? And how about an ocean home? You could, I promise you, that little casita right next to the main home, you could make do with. In short, I really love short-term vacation rentals. And here's why I love them. And there are 15 reasons that I listed that I think may help you embrace it or not. And I'm not trying to tell you what to do. I'm simply telling you what I think. And you be the judge. My desired outcome from a call like this is for you to be a better informed investor. You choose. You choose your life. You choose your investments. You choose the way you want to end. But I can tell you, living in a place like that isn't bad. I like it for one reason. My favorite business models in the world allow you and I to borrow and leverage other people's technology and other people's assets to make you and I money. You see, Airbnb created all the technology. You didn't have to spend a dime. They spent billions. And now other people own homes that you're actually able to lease and then sublet. And all of that you didn't have to stroke a check for other than a monthly fee for Airbnb or a rent payment. But the rest, literally somebody else put up all the money in the technology. I love the fact that other people share their research and leaves us clues. Remember Airbnb's acquisition of luxury retreats, not Joe Bag of Donuts retreats, but luxury, a $300 million buy. How about AirDNA, which you saw some of before as a resource? How about now maybe you realize that owning is the slow way to wealth, that it's not bad to own, but you could literally control a lot more property with a lot less money and accelerate your success and optimize your reward and minimize your risk over and over again. Real estate's at a point in the market cycle where luxury homes are going to be one of the first two categories to be hit. So if you are looking, luxury owners, in my opinion, will become increasingly motivated when the market makes its shift. And making money in big chunks, isn't that the beauty of real estate? You can make money in big chunks part-time. A part-time vacation rental, like the Vegas Skybox, generated $157,000 a year. You realize how hard it is to make $157,000 in corporate America, or $96,000 on the Sandcastle, and that was only 2 properties. Real estate allows you to do both. I love making money before I have to fulfill on it. You realize that if you rent a property on Airbnb, you get paid today, and you don't have to fulfill on it until the person moves in to rent it. Well, you get to collect now and leverage that money. I also love it because I know it works. 12 years now, and it's a lot easier now than it was a decade ago or more with the technology that I didn't have then. Recurring revenue. When you can set something up and it keeps printing money, just compare that to wholesaling and flipping, because when you're done with a wholesale or a flip, you start all over again. Who wants to have to do that? And especially at this point in the market cycle when it's so difficult to find inventory. Passive and recurring income. My desired outcome, and it should be yours, is when you can set something up. It takes a while. You got to set it up. It's active when you set it up. But then if you automate it and systematize it, it becomes recurring and passive, or at least semi-passive. These are actually the kind of tenants I want. I've had Section 8 tenants. I grew up in a trailer park for the first 20% of my life, but if I have the opportunity to choose, I like the tenants who rent these properties better. Some people may be scared of luxury homes. That's perfect. You and I have less competition. How about doing a separate purchase option where you make money now off leasing it and cash flow, and you exercise your purchase option, your buy option later, if you choose to, and if you don't, you don't. But if the market goes up, you're going to exercise that option, and if it goes down, you won't. Well, what else? What if you could resell it on net operating income, which is how commercial and multifamily properties are evaluated? In other words, their value is not based on residential, it's based on net operating income. Well, when you have income producing homes and you've got several of them, you could literally sell a portfolio on NOI, not based on the appraised value. You could fractionalize them like I did and sell shares. And the beauty of it is, unlike a timeshare, you literally own the home. And anyone who buys a fractional interest owns their fractional interest in the home. It's not just air like a timeshare would be. And then lastly, use of a luxury home for strategic and fun reasons. As I mentioned, masterminds, a thank you to Clay, trade outs for other products and services, swapping with other vacation rental owners when you get tired of your place. Literally, the list is never ending. So does the opportunity exist today, given that real estate is doing so well? And I'll tell you that there are 2 things I said all along, and I always say, no matter where I speak, that will first get hit when the market shifts. What are the 2 things that will be impacted first? Luxury homes and generally 1-1 condos. Now let's talk about 1-1 condos first. The average American household has 2.63 people in it. So that's not big enough for a one bedroom. So ultimately, they prefer two beds, but they can't afford it. So they get a one bed, and 65% of condo sales are two or more beds. So ones get built, or they get converted from an apartment to a condo when the market's hot for singles. When the market softens or interest rates go up, those entry level takeout buyers, where a one bed made no sense in the first place and really doesn't now, they can't qualify anymore. People generally didn't want a condo anyway. So I think one bedroom, one bath condos, anytime a market corrects, will have an opportunity for you to use it as a vacation rental for people short term, because there isn't a really strong buyer pool and they're the first things that get hurt. The other thing is luxury. Again, the buyer pool is small because it's expensive, but it really dries up when interest rates go up or home equity starts to erode. Now, that's not happening right now, but I'm giving you a glimpse into the future. So for those few buyers that are still interested in a seven-figure income, financing may become an issue because lenders don't want to lend on luxury once the market starts to turn. So they either tighten their credit box or they raise their transaction costs, or both, to the point where people either can't qualify it or they can't afford the origination. Well, this happened early in the COVID crisis. Banks tightened their belts. Jumbo loan products were the first to go, but now they bounced back. Well, guess what? It doesn't happen forever. Look at the date on this article, August of 2020 last year. At that time, Miami had 30 months of unsold condos after COVID ravaged its economy. And you might say to yourself, well, look, it was really a difficult time for all real estate at that time, wasn't it? Yes. And so these condos have probably come back, haven't they? No. You see, if we fast forward to downtown Miami in 2021, what do we see? Well, look at the number of years required to absorb the current inventory at the rate that it's selling, or arguably not selling. Remember before, when we first bought the Vegas Skybox, I showed you that it was 14 months supply, and I saw an opportunity. There's 11 years supply. You could imagine what the opportunity could be. Well, remember when I said the first things that get impacted in a real estate market correction were luxury and condos? How about luxury condos? So those are the kinds of opportunities that will exist for you and I, because we're now better informed and we know a little bit about what might be coming next. So I love being an investor. I believe research is our unfair competitive advantage, which is why we spend so much money on it. So what should you do about what you've learned today? And we'll wrap up. Number one, cheat off me. This is my opportunity to do good and give back. Win the money game. The same triangle I drew for my sons: generate income, accumulate wealth, and keep as much of both as you can. That's why you have a self-directed IRA. You can do private lending like we do to generate cash flow, or you can do real estate investing, short and long term. You can accumulate wealth by scaling a private lending like we have as a family office that has done tens and hundreds of $millions of loans. And my son went on to create a little company that you've heard of in 4 years to over $1 billion, and the biggest in the space. Or you can start with one real estate home, buy it in the right market and get appreciation, finance it and get leverage, or invest like we do in technology, which is not the topic for today, but we may talk about it, who knows, in a webinar in the future, because we're passionate about technology investments because they're eating the world. How about cutting expenses, using tax deductions or 1031 exchanges? All good things to do. But what about your Roth self-directed IRA, or a solo K, or a SEP, or any other self-directed plan that Clay's the master on? Or living in Puerto Rico, move over here with me and look at that every day. And imagine that you and I both have one goal. Every single day, we make double-digit passive recurring interest income, regardless of our active income. Then invest it and reinvest it. Keep it. Optimize our effort to return ratio by getting the best stuff that takes the least amount of effort, and do it all from a backpack anywhere in the world like we do. If you're interested in this, and if you're also interested in what my single largest epiphany in my life is, what I call my Jerry Maguire epiphany, it's literally called the power of six. It's about having less people in your life rather than more, because everything you've ever been told in terms of networking is nonsense. It's about doing fewer bigger things with fewer better people through fewer deeper relationships. That's what we've realized. And my son implemented it at Stanford. And his two roommates at Stanford, one is now a billionaire, in addition to my son who created a billion-dollar company, and the other one has several billion-dollar funds, and they average 35 years old. That's why we created Access Insiders. If we can all do more together than we could alone, wouldn't that be a wonderful day? Well, at the end of the day, I'm offering you three things. You can just ask, and we'll give you a free copy of the Power of Six white paper. Again, it's the single biggest thing that's ever happened in our family's life. Number two, Clay, I'm sure, will offer up the replay of today's webinar. And number three, all you have to do to get these kinds of webinars for no cost or receive market alerts or invitations to future webinars is go to accessinsiders.com/Advanta, the same URL that I gave you at the beginning to write down. It's really for serious investors. And if you're interested in those three things and the advance alerts that we send out, our research reports and opportunities in the future, I don't know why you wouldn't at no cost. All you need to do is go to that page, accessinsiders.com/Advanta, scroll down, fill out some basic info, click, the serious, yes, I am, not just curious button, you're done. So I hope you enjoyed this. I hope you found your mind being expanded to the possibilities. And again, if you want more, feel free to go to accessinsiders.com/Advanta. And Clay, I'm done. So if you want to ask some questions or you want to entertain some, I'm ready to roll.
All right, Dave. Hey, thanks so much for that. That's really a interesting presentation, certainly thought-provoking, and I hope everybody enjoyed it as much as I did. So there were a couple questions that came in, and then there's one thing I just thought that you and I would discuss real quickly. But for those of you who are, need to go about your day, I really appreciate you spending some time. We are going to spend a little bit more time at doing some questions here, but if you need to split, totally understand. And thanks a lot for participating today. And hopefully you got some great information out of it, and we'll see you on the next webinar. But for the moment, the first question I was just going to come back to, it was actually an IRA question that asks, can you explain in-kind distribution of transferring a property from IRA to personal in greater detail? And I'll give it to you again in as encapsulated a form as I can. So when your IRA buys a property, the IRA itself, that legal and financial entity that is your IRA, and it does have a different name, different bank account, different tax ID number than your personal information. It is the owner. The IRA is the owner. And so a distribution in kind basically means that you go down and do a change of titling on the deed. So you change it from ownership of the IRA to ownership of the person. Now, the distribution rules still apply. So if it's in a traditional IRA, the property would need to be appraised, and your tax on the distribution would be the value of the appraisal. If it's a qualified distribution in a Roth, obviously there's no taxes due on a qualified distribution from a Roth. So it doesn't change the tax event. It just means that the distribution is in a non-cash asset, and in the case of real estate, it's really a retitling kind of exercise. Okay, so that was question number one. Dave, I think we got a couple more here for you, so I'm gonna read those off to you. How do I run numbers on a vacation rental?
There are calculators that allow you to do that, just like there are calculators that allow you to do it on a long-term rental. So you're going to be able to find calculators on the internet that will allow you to basically run your numbers on a long-term rental. They're all over the internet. So those calculators, where you simply put in your gross rent and put in your expenses, will ultimately allow you to get the information that you need. Now, there are similar calculators in the short-term vacation rental space. It's a little more complicated because, of course, there are different seasonals where sometimes you're making more rent than other times. Sometimes you have higher occupancy than other times. And those are the two primary inputs into your calculator, because expenses, are, generally fairly stable. Your rent, all of your maintenance, that sort of thing. The only variable in your expenses for the most part is housekeeping, but that's only done when the property is rented, and that's paid for by your tenant. So you're literally going to be able to find calculators that allow for you to calculate whatever you need to do. That's the beauty of the internet these days.
Mhm. That brings up something for me too, Dave, to follow up on something you said. So you had to educate yourself on short-term rentals and how you find people to rent, and also how to manage it and all that kind of stuff. Do you have tips for people on how they, how do they promote their short-term vacation rental? Are there basic tools that you like?
Yeah, there are tools that I like, and the two primary ones for promoting anything, and this shouldn't surprise anybody on this call, because if you've ever stayed in a vacation rental, you've gone to one of these two sites, either Airbnb or VRBO. So when we were starting out, there was only really VRBO. Yeah, there was HomeAway, there was vacationrentals.com, but they were all syndicated by the same company, HomeAway. And VRBO has become, I'd say, the biggest one generally, in addition to Airbnb. And so those are the two tools. In terms of educating yourself, what I always like to tell people is, after everything we've talked about tonight, what is your single best investment that you're going to make next? And my answer is in yourself, because we've become successful because we've invested in ourselves. And I really mean that. I know it may sound trite, it may even sound cliche, but think of it this way. We know what's coming next. How did we get that? Well, because we figured out research and how to get research in order to know what's coming next. And at the end of the day, deals don't do deals. People do deals. So if you're not educated yourself, you find yourself in a position of always playing catch up because somebody's smarter than you. So I would look for groups that provide vacation rental education, and they are out there. And if you're interested, I can send you at least one or two that I'm aware of and actually refer you to them. But it is really important before you start charging off and doing something like this that you learn what you're doing. And then imagine, buying a luxury home, and imagine doing it in your self-directed IRA, and imagine being able to rent it for X number of years and generate that cash flow and then distribute it to yourself and live in for the rest of your life. I just think that is way too cool. And so anyway, that would be my answer, Clay.
Yep. Okay. And this is kind of a little bit of a play on that, but it says, do you offer a program that partners with people to find vacation rentals?
I don't. There are 6 F's of real estate. You've got to find it, figure it, fund it, fix it, fill it, and flip it. Those are the 6 F's of real estate. And each one of them takes a different skill set. To find it, you have to be a good marketer. To figure it, you got to understand a little bit about finance or spreadsheets. To be able to fund it, you got to be able to raise money. To be able to fix it, you got to understand contracting and construction. To be able to fill it, you've got to be a property manager. And to be able to flip it, you've got to understand sales. Think about that for a minute. That's why most flippers fail, because they're not good at 6 different skill sets. By contrast, the angle that we've taken, and believe me, we did 73 flips in 14 months in Las Vegas when no one was buying property there, and we were buying like drunken sailors, if you will. What I learned was that funding, being a private lender, was the best effort to return ratio. All I needed to understand was how to fund a deal, whether it was my money, whether I raised a fund to do it, which we have, or whether I brokered the loan to someone else. Private lending is the easiest of all of those. But if you choose to do vacation rentals, you can either lend on vacation rentals to somebody else who's either buying one or renting one and needs that money that we talked about in the example earlier, or you can actually own one or lease it yourself. So it really just depends upon which of the 6 Fs you think match your skill set and which of them you get the most excitement out of. And then lastly, which of those provide you the most upside? So that's, hopefully that answered that question.
Yeah. And let me go back to it. You and I discussed this when we were prepping for the presentation today. And I thought it was an interesting thing because, one of the really interesting ideas that you presented was how a person can own the vacation rental and also live on the property. And we were talking about how that, if that could work in an IRA, or if it needed to just be somebody's personal investment strategy. And I just wanted to, I'm not sure whether you've seen this or not, and maybe you can weigh in on this, but from my perspective as a person in the self-directed IRA space, I would say that generally speaking, if your IRA owns the entire property, you would not be able to live in it, even on the guest house. So that doesn't mean that you couldn't do it. It just means that the single property would have to be able to be actually 2 discrete properties. In other words, the same, it could be the same compound, but it would need to be different properties so that the IRA could own the main house and the IRA holder personally could live in and own the house that's next door that happens to be the guest house. So there would have to be there's a certain very specific set of circumstances that might work from an IRA perspective. And that's not to say you can't, again, this is just the IRA part. You could certainly do it in your personal. Have you ever seen properties that have that kind of separation, Dave, in terms of vacation rentals, or is that just kind of would be a unicorn?
Yeah, the answer is I haven't seen it.
Yeah.
But my question kind of comes back to you. And by the way, Clay, I told you this. I'm not a tax attorney. I'm not a CPA, and I don't play one on TV. So you've forgotten more, and I mean this. You've forgotten more about understanding the prohibitions within the self-directed IRA space than I know. But I'm pretty knowledgeable about it because I've learned from folks like you. What I would do is put it back to you. Is there a way to structure it in a way where you could lease the property, maybe in a LLC, a self-directed IRA held LLC, and actually be able to lease it and do the arbitrage that we described before by having a property manager that could do the same thing, having an option to be able to buy the property in the future. And look, I'm not trying to put you on the spot. I'm not trying to create chaos here, but is there a way to do this in a way other than owning it? Is there a way for your self-directed IRA to literally be able to own something that has control of everything?
It's a great question, and I appreciate you bringing it up. And my answer is not going to be terribly satisfying, which is basically we'd have to look at every circumstance individually and exactly what it is that the IRA owns, and then what the person's participation is going to be, because that's really where the rules kind of live or die. That's the inflection point. So we'd have to look at it. But I'm always open to new strategies and ways that people are, run a strategy by me. I'm happy to talk about, what I know and whether it can work and what the IRS thinks about it and that kind of thing. So it's a good discussion to have. And I guess the overall point that I'll just make and what I wanted to point out in terms of bringing back this discussion that you and I had was just, all these strategies, they may not all work in an IRA, or they may need to be altered a little bit. And that doesn't, mean that they're automatically out or anything, but and certainly you can do this with your personal finances. So just trying to draw that distinction.
Good point. Good point. Yep.
Okay. Well, I think that, we're running quite a bit over time, but so I wanted to just ask you one that I've seen echoes of this. Well, first of all, I'll say for those of you who typed in the question box about the recording and that kind of thing, yes, this has been recorded. Yes, you will get a link to it. It comes automatically through GoToWebinar, so you'll get a link to the recording. It usually would be out tomorrow. And if you don't see it, or it goes to your spam or whatever, and you would like a link to the recording, I'm happy to provide that for you. So go ahead and just shoot me an email. But for today's presentation, let's go ahead and wrap this up with this last question. It's one of the ones that I think that was is echoed in some of the things that people are asking on the Q&A, which is what are the markets that you think are best now for short-term vacation rentals?
Yeah, it's a great question. I get it all the time, and you know, the answer is, of course, it depends. But let me put a little bit meat on that bone. Um, there are some markets that are more vacation rental friendly. There are other markets that aren't friendly at all. In other words, they don't want vacation rentals, either because they get a lot of votes from the hotels, or maybe they get complaints from homeowners, or maybe they just don't want the bureaucracy. But it's been increasingly more positive toward vacation rental owners, I believe, as more and more vacation rental owners have started paying tax. You see, back when we were doing it, paying tax was sort of an honor system, and now, you know, taxes can get withheld from bookings in order to make sure that taxes are being paid either locally or otherwise. So I think that was a big thing, is are the markets friendly to a vacation rental owner or landlord? The second part of it is, what markets have a desire? You see, if you're trying to rent something in, I don't know, Wyoming, there's a good chance that if it's near Yellowstone, it's going to be rentable year round. But if it's remote, it's not going to be rented at all. Or if it's somewhere else in the north where half the year, I always joke that half the year is summer and the other half the year is road repair. So it's very difficult to have vacation rentals in markets where the seasonal isn't favorable for you. And then the last point is that there needs to be what I believe to be more of an event draw. So think about Orlando. There are a lot of vacation rentals in Orlando because of Disney World and because of all the other theme parks. Whereas there are other markets that would love to have vacation rentals, but can't sustain them because no one wants to visit there. And so it's not an easy answer. I will tell you that my favorite market is Scottsdale/Phoenix. They're the best combination of friendly, year-round climate, even though it's hot in the summer, and the overall notion that you have an opportunity to get a great rent to price ratio. So if you're going to buy it and pay for it, you're going to get a pretty good rent rate on it. If you're going to rent it and then sublet it, you're going to get a nice yield. And so that's one of the markets that I found to be the best. But I'm sure folks on this call, if you do have experience in that, have made money in any market because you can. Remember, a long-term rental is rented for 12 months generally, and the rents are much lower. You can have 65 or 50% occupancy in a short-term rental and make a lot more money than you can with 100% occupancy in a long-term rental, just because of the rent time frame and the premium that you're able to get. So hopefully that answered it. It was a little long-winded, but I didn't want to just give you a, well, it depends. I wanted to be as instructive as I could. So hopefully that was helpful.
Much appreciated. All right, Dave, I think that we're going to go ahead and wrap up today. I understand that there are a few outstanding questions, and I will certainly email you responses to that. And certainly, you know, I put my contact information up there for those of you who want more information. I'm going to switch it back to Dave's screen here again. Dave, if you'll put up your end screen again, that would be great. There you go. So you have contacts for, you know, both ends of the presentation today. Dave, really appreciate you putting this together and sharing your expertise with us. Thank you so much.
My pleasure, Clay. And I wanted to thank you one last time. And I also ask everyone on the call, if you've benefited, email Clay. Let him know that you appreciated this. Recognition feeds the mother of soul. And I think there's a real opportunity for you to tell him what you think. So, Clay, appreciate you, man. We'll catch you later.
You bet, Dave. And everybody, thanks a lot for spending some of your day with us. Hope it was helpful. And we look forward to working with you in the future. Bye now.